Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is self-storage expert and president of Kingdom Storage Holdings, Scott Myers. Now, Scott has acquired, sold, developed, and or converted over 40 facilities, totaling over 14,000 units and 2.4 million square feet of storage. He's also the founder and president of SelfStorageInvesting.com, a leading self-storage education company that offers courses, live events, and mentoring and coaching. And aside from his real estate activities, I think probably one of the coolest things about Scott is his dying devotion to both his family and his faith. And Scott's very active in his charity and mission work, both locally and around the globe. And then funding and building homes and giving them away to deserving families, which is really, really cool. I've been wanting to do it with him for years now, and ultimately one of these days I'll take my son with me and we'll go do that with Scott. But he's given away lots of homes to very deserving families, and Scott's a real deal, guys. And so I'm excited to welcome him back. It's been a lot of many years since we had him on, and so excited to have him back here. So Scott, how you doing, my friend?
Kevin, always good to see you again and to be able to catch up. I'm doing well. How about yourself?
Yeah, doing great. Family's well. Everyone's healthy. And so life is good. That's all
Good.
that really matters, right? That's all that really
Absolutely.
matters. So Scott,
hmm
you're kind of an icon in the self-storage space. You've been around doing this for quite some time now, but I'm sure there might be a few folks that are listening that don't know your background and, kind of where you came from. So maybe take a few minutes and I guess give us kind of the run up to you getting into the self-storage space. I know you got your start in other aspects of real estate. So maybe give us a little bit of your background if you would.
Sure. Yeah. So it got started like probably just about everybody in real estate, and that is by buying one single family house. And so we bought this house with at the time, Kevin, this is going back to 1993, had an assumable VA mortgage on it. So it was real easy for somebody to come in who didn't have a lot of credibility in real estate, as well as huge credit scores and gobs of cash. It was really easy to get in. So we bought this using the Carlton Sheets method. I'm dating myself. Maybe some folks remember Mr. Carlton Sheets. And so we fixed it up and rehabbed it, refinanced it, rented it out. So the Burr method before was even called the Burr method, and then bought two more. And so we continue to do that, rinse and repeat. Bought, I think about 76 single family houses. And then we got into apartments. Decided we still didn't have the cash flow and the freedom that we wanted in real estate, like Carlton and the other gurus had talked about. And so we just had a lot of management challenges along with some cash flow. So we thought, well, economies of scale will fix this. So we'll get into the apartment side of the business and buy more. And so we ended up buying 4 apartment complexes in central Indiana, where I live here. And then we ramped that side up to about 400 units. And so we had close to 500 that we're managing all together, and not a huge portfolio, but still not at that point, really, that tipping scale where you can turn everything over to third-party management and the debt's paid down or paid off that allows, the freedom to just write a check for anything. We still had to have our hands in the management side of it. And so, and then after a dip in the recession in 99, 2000 and almost losing it all, I decided, all right, I think I need to look at some other asset classes in real estate. And so without hassles of tenants and toilets and trash, and basically, that left us with two. That's self-storage or parking lots or parking garages. And at the time we began looking into parking lots and garages, there's not a whole lot of value you can add like you can to an apartment complex, or even a single family house to raise the values, or in a mobile home park where you begin to do different things with the utilities, rental increases across the board. I mean, there's many ways that you can force the appreciation, but you really can't do that with parking lots. And so I'm interested, side note, Kevin, to learn more about what you're doing on that side as well.
Yeah, I had no idea. So that's great. That's an interesting topic. So in any event, I don't want to interrupt you.
No, that's all right. So then, self-storage, has all the, it ticks all those boxes. It has economies of scale. We can buy multiple units. If you make a rent change, a price per size, across thousands of units, that makes a big difference. And utilities and, anywhere else in that side of the business, but, without the hassles of, people living in the units. And so the more I dug in, the more I liked really what I saw. And so we bought my first self-storage facility with a partner, and that worked out really well for a while. He bought me out later on and just kind of saw the light and cut our teeth together, and then began selling off all the houses and the apartments, and then just went full bore into the self-storage side of the business. And, at the time, this was back in 2005 when I got into storage. So going on 16 years now, there really wasn't a company or, an individual or a guru, if you will, really teaching people about that side of the business. And so I went to the trade shows. I paid for consultants. I paid for other access to resources and people that could help me in the business. And then just recognized, several years later into the business, that, hey, there may be a business in helping other folks because there wasn't anybody out there like when I was looking. And sure enough, we opened up our education business and started with the home study system and then live events and mentoring and coaching. And that's really taken on a life of its own. And so, we have the largest education business in self-storage, and we're growing to roughly we're about number 20 in terms of size of businesses in terms of self-storage facilities nationwide as owners and operators. So the one feeds the other, and the other feeds the one. And so it's been a pretty good partnership and marriage between the two businesses. And yeah, life is good right now. Just raising more capital to do more deals and some larger deals. And now some of our first generation properties we're moving out, like you and I talked about before the call. And so life's good. Life is good in the storage business right now. We actually do very well during a recession and during a pandemic. We don't celebrate either of those things in our economy, but the storage industry benefits greatly from that. So we've had actually a pretty good year and a half.
Yeah, no, that's amazing. I appreciate you giving me that background. And I want to back up a little bit to, your days of single family and the apartment complexes.
Mm-hmm.
It seems that the theme at this point in time is that, rents always stay stable or they go up, right? And that's what's ultimately occurred over the last decade. But I think you and I can both, and I don't know your whole story about like what ultimately happened with those units, why you guys struggled during that the recession back in the 99. But also, I know what occurred to us during, the 2008 crisis. We did have markets down here in Florida where rents did go down, where there were concessions for a long period of time, which, concessions are equivalent to that of a rent decline. So rents do go down. There have been historical times when that's occurred. So I guess what were the biggest pain points during that period with that residential portfolio that really made you guys struggle?
Yeah, so that recession, the tech bust back in 99 and 2000, when the bubble burst at that point, the economy tanked. And so the administration at that time decided that, one way to spark the economy again is to get people buying houses. And so the Community Reinvestment Act, or known as the CRA, was administered, and that was the piece of legislation which allowed, and I'm paraphrasing here, this is my term, not the legal term, but that anybody that could fog a mirror could walk into a bank and get a loan, and they can roll in the credit card debt, and they can roll in their auto loans and anything else and buy a house that appraised higher than what it was worth. And the idea behind the Community Reinvestment Act was to spark home ownership. But really what it did is it just allowed a lot of bad debt to be created. And so, we all know what happened in 2008. And if you've watched The Big Short, I lived that. And so we had all these rental houses. And this was the best time in the history of America that you could buy a house, or people could buy a house, and it was really easy. And so who could blame them? This, home ownership was available to anybody. All of our renters were then rolling all their debt in, buying a house because they could now, and leaving in droves, and who could blame them? So that left us on the apartment side with very large vacancies that we had to try to fill up. But then on the housing side, again, not sizable, but individual mortgages on each one of these properties, and I had about 78 of them. And we'd rehab them, 5 to 10,000 after we bought them to get them rent ready. And again, this is 20 years ago now. And now we were spending 15 to 20 to 25,000 to change with the economy and what the market was doing, and we had to rehab them again, but now rehab them to sell, to retail. So we're kind of in the hole. We're doing our second rehab on them, and we got high vacancies because it was set up as a rental portfolio, and now we had to shift gears very quickly and turn into a retail company. And that just was a huge drag on our cash flow and a huge drag on all of our resources. And so we used up all our cash and borrowed every bit that we could to continue to then rehab these houses and sell them off to feed where the economy was going now, these first-time buyers. So successfully, we did so, made a little bit of money on the housing side when we got out. When we sold all our apartments, we did very well on the apartment side once the economy turned back around again. But then, through all this, just realizing that, again, it's not much fun. People are lying to you if they say they love to be in, the rental management business. We all love real estate if it weren't for the tenants. We love the fact that they pay our properties down, but the day-to-day is no fun. And so that combined with, living through that swing of what it looks like to be in real estate when the market completely shifts and the renters become buyers and being caught in that again was what made me realize that I think I need to take a look at this business model and maybe even a different business model within real estate. And so that's why we made the shift.
Yeah, no, I appreciate that. And that was a very interesting time. I remember back in the day, they had 110% loan programs
Yeah.
out there. I mean, just
hmm
when you think back on it, it's like, what were they thinking? I get what they were
Yeah.
thinking.
Yeah.
Just
All the way down.
folks
hmm
with 540 credit scores,
hmm
rolling in auto loans and credit cards and all
hmm
that into a home that is now upside down.
It's
And then
nothing but a recipe for
then you
disaster.
had those fancy pickup payment loans. You remember those?
Yes.
Negative
Ah,
amortization loans. Oh my gosh.
yeah.
And I'll give you 4 payment options. One of them is negative amortization. Which do you think most folks are going to pick? The
Yeah.
cheapest loan payment. And that's ultimately what they did. So
hmm
in any event, not to get sidetracked here. So let's talk about
hmm
self-storage. Let's talk about,
Sure.
your brand, Kingdom Storage.
hmm
How important is it for someone that's getting into the business, that's looking to actually not just buy 1 or 2 facilities, but looking to actually create some type of scale? How important
hmm
is it to actually create a national brand like you've done with Kingdom
hmm
Storage?
Yeah, so Kingdom Storage is not many people know them because we don't have that name on our facilities,
Oh,
and
okay.
so
I
Kingdom
didn't know
Storage
that.
Holdings is truly our holding company, and so
Hmm.
it's forward facing only in the fact that our partners that come alongside of us, our equity partners, for syndication purposes, and our holding companies, and the things that I do on LinkedIn, and when I speak at the trade shows and what have you, people know us from that standpoint. But the consumer side is they're branded with sometimes the third party management company. We use some of the REITs or the larger national players to manage our facilities. Many are still named the name of the city. So if we've got 2 or 3 facilities in Shelbyville, then it's shelbyvilleselfstorage.com.
Okay.
Because we want the domain to be the name of the city when people are looking, in order to win that game, so we don't have to pay as much for traffic. And depending on the partnership that we have, it'll be named, that will be the name of the facility. Or if it's already, existing and it's doing very well, we don't want to have to start over with a brand name again. So it,
Hmm.
really depends. But we haven't built a national brand on the facilities per se, because it's all about eyeballs and traffic and doing it as cheaply and to be able to leverage as much as possible to be able to get people to our site. So that's how we've taken the approach to marketing our facilities.
Very interesting. So it sounds like even from a digital marketing standpoint, of cost per impression or cost per lead, it's
hmm
much more beneficial just to name it something locally than that of have your own brand that might not be recognized in the area that you're in at present, unless you've
Without a
got
doubt.
multiple facilities. So very
hmm
interesting. So
hmm
one thing you just mentioned there, third party management. That's it's something we've had other self storage operators on the show over the past, but I haven't interviewed one, I don't believe, that actually uses one of the larger outfits to help
hmm
them with the management side. So talk to me about that a little bit, that business model specifically. Are
hmm
there pros and cons associated with working with one of these larger
Yeah.
operators? And I think a lot of folks, if you've never gone down this road before, and I'm not saying that's the case here, but we've gone down the third party management road, and a lot of folks always think bigger is always better, right? They've got more resources.
hmm
They've got more capital put towards R&D and blah blah blah, and
hmm
sometimes too big is a much more horrible situation as far as um, I guess the efficiencies associated with them managing your
hmm
property. So anyway, I'd love to hear your experience
hmm
as far as how that's gone. Would you? I mean, are you going to continue running that business model? And if so, I guess just I don't know. Now I'm just rambling here. Just tell me more about third party management, how it's gone
Well,
for you.
you're rambling, Kevin, because this is a discussion we have all the time. It's ongoing, and there are thousands of facets to it. And you just touched on 5 of them. So, absolutely, there's a lot of considerations, and it ebbs and flows, and we continue to go back and forth. And it's not because we don't know what we're doing or because we can't make up our mind. It's just that the challenges are always there. So when you're first starting out, unless you buy for us in self storage, but call it a mobile home park, call it an apartment community. If you got a large enough facility that has enough dollars in it and in revenue that warrants a third party, to underwrite a third party property management company in place, you certainly want to leverage your time and not have to self manage, or at least oversee too many facets of it, and then have staff on site. So, the discussion is, well, let me make this blanket statement. First of all, nobody cares 1% as much about your facility or your apartment complex as you do, or your mobile home park, period. Just
Absolutely.
bottom line. Nobody is going to be able to fight for every dollar that comes in the door and fight for, to reduce every expense and line item on your P&L like you would, period. But at the end of the day, you have to have, if you're going to scale and grow your business, you can't do it all, and you certainly don't want to really hire folks to be able to handle that all, because they also have to be on board, and they don't care 1% as much about it because they don't have any equity in it. They're collecting a paycheck, so you can build it out internally, and ideally that's the best if you can figure out a way to scale that and build an incredible organization and an incredible culture around it. That is the best way of doing it. But that takes a lot of time, that takes a lot of money, and to get that machine going is several years. But then comes the economies of scale. If you are buying a facility, or you have multiple facilities or entities that you're trying to manage across state lines, well, it's a whole heck of a lot easier to be able to hire a third-party property management company that is already there. They already have district managers, regional managers that can go and hire for the site, train the people that are there, and then if somebody leaves, or you have to let somebody go, or they let somebody go, they plug somebody else back in, even temporary, from the organization that's sitting on the bench until they hire somebody else. Also, the economies of scale they have in marketing. If it is a national brand, a REIT, like the big ones out there, like Public Storage or Extra Space or Life Storage or CubeSmart and Store Space, and the others that are in the third party side, they've got a website and they're already paying for traffic. And so you plug in your site and it's already there. It already moves to the top. And so that the eyeballs are already looking at this site, and you can now direct your traffic that you pay to your facility on a platform that's already proven. So, there's a lot of economies of scale that fit in, and then just also that national presence where you can move faster, very easily move a lot faster by plugging into their system and what they already have in place. What you give up then is control and going at their speed and using their systems. And if you happen to move away, if things aren't going well after 1 year or 2 years, then you're either moving over to another third-party company, or if you take it back in-house, then you're starting all over again with your site and your domain, and building that brand presence back up again. So there's, and for every one of those, there's another 10 more considerations that, again, we go back and forth. It is usually more costly to go with those companies. When we underwrite, and I'm not sure, Kevin, if it's the same for you. I think it is in mobile home parks. We're underwriting to 5 to 6% of revenues for third-party management fees.
Yep.
But at the end of the day, once you get into it, once you start paying for the call center and the marketing and advertising, it ends up in 9, 11, 12% all in. And so, when you say, when somebody thinks that they can just, put a third-party property management company in place for 5% of revenue, and they say, well, that's cheaper than what I can do it. The reality is a little bit different than that. It's almost double. So now I'm beginning to ramble, but I think that answers your question to a degree.
Well, I think what a lot of folks don't, what they don't bake into that 5%, like a lot of third-party management companies, the professional ones, I mean, there's lots of ancillary items that aren't umbrella underneath that 5%. And so, I mean, the additional items add up fairly quickly. And like you said, get to 9, 10, 11%. That's ultimately the number that you end up paying percentage. I think the last third-party management company we use, I think it was somewhere in the range of like 11.5% when you actually added everything up. So definitely far from 5%. That's for sure.
Correct.
So with these third-party management companies, these larger operators, are you actually branding? So let's just use Public Storage as an example. So like you're actually branding it. Everything's branded Public Storage, but it's your facility. Is that exactly?
And I think it makes sense if you're going to go with a third-party management company. I mean, that is one of the reasons to do so, is because they have that national presence and they've got economies of scale, and they can spread the brand across the website and the marketing dollars. So yeah, absolutely. Their sign goes up, and they it is part of that brand. We're still the owners, and we don't necessarily get to call the shots. I mean, we kind of do. That's negotiated up front, but we're really just watching over them and keeping our thumb on the management companies versus driving the vision and the direction, and trying to understand the markets and doing everything else. We just meet with them on a regular basis, and they get to carry out our vision, if you will. But we're not telling them what to do, and they already have a system that's already proven. So we don't step in and try to dictate what's happening after that.
Do they require any type of like first right of refusal as far as if you intend to sell the property? Is there any type of restrictive nature in there like that?
Yeah, that's one of those pieces that we negotiate, and that can be good or bad. You can put a first right of refusal in, which means that we have the ability to market the facility, and or soft market it. And if we get some offers that come in, then we throw it back to them and say, if you can beat this, or match it or beat it by $1, whatever that looks like, then you can have it. But first right of refusal can also work against you in that instance, in which they get the right to buy it no matter what, exclusively. And that's a situation where folks may not want to get into, because there is there's an opportunity for the management company to not perform well, and the value of the facility goes down, rental goes down, the net operating income goes down, and so all of a sudden it's operating down here. And a management company that is, I'm not saying one of the national ones, but any management company, if they're nefarious, and they could suppress the performance and then come back and say, well, I thought we could perform better. I guess not, but I'm sorry about the situation that you're in right now, but we'll buy it. We'll take it off your hands if you'd like, or something along those lines. And so, if we're going to have that first order refusal in place, it has to be the highest and best. They have an opportunity to beat something else, but not that they get the ability to buy it, because then that could create an instance in which they're driving performance down in an effort to truly own the property, if that makes sense. And again, I don't want to paint the picture that third party management companies do that, but and the national players, you're not going to see that. But it happened to me once with a smaller company early on in my apartment days, and so we're keenly aware of that.
Sure. Last question, then we'll move on about third-party management. Have you seen successful models out there? And I'm talking large scale, where a syndicator developer ultimately is just going to hang that one brand shingle and build out a multitude of self-storage facilities. Have you seen that successfully play out on a larger scale?
I have, and we're getting ready to embark upon that right now. We're starting another fund, and I'm also participating in some other funds, and I'm looking to bring this company in because they cover the gamut. They also handle the investor relations side. They have a full-on suite and full-on platform, and so they understand both the syndication side and from an investor standpoint and what we're driving towards, as well as the third-party property management piece, and they have incentives in place for both, and there's no incentives for this thing to underperform, and so. This company has it going on, and we're looking to make that switch and then bring most everything under the fold here very soon. It doesn't always work that way, because the bigger you are and the more that you have in place with one brand. If it doesn't work out well, obviously that is painful to move away. And that has happened with some folks, and there's nothing wrong with, at least in our industry, and also with mobile home parks, and I would assume that with parking garages as well, Kevin, that our market's pretty small. We're only drawing from 3 to 5 miles. So to have a national brand to move up from one to the next, or hang a different shingle, out front, a different flag and sign, it doesn't make that big of a difference to the consumer. But for us internally to essentially start all over in a transition, 2 months performance is, it drops and it declines. So you want to pick your partners very carefully, and you want to make sure they're aligned. And always, I guess, if I could paint a broad stroke, anybody before they sign a property management agreement with any property management company, a piece of their compensation should be tied to performance, period. We don't, there's hardly anybody in my organization that gets paid, just for filling in hours, trading dollars for hours. They have KPIs and key performance indicators that they're responsible for. And everybody in my organization and our management companies, they get paid a portion of their compensation is based upon performance and hitting some metrics.
Yeah, no, that's beautiful. There has to be alignment of interest. Simply put. And again, like you said in the beginning, there's never going to be any third party, no matter how good they are, that cares for your property as equally as you do. It's just never going to happen. Never going to happen. So moving on here, for those folks that want to get started, what is the path of least resistance getting into your first facility? It's from market to size to any other factors involved there as far as getting into that first facility. Like the first one's always the most difficult, right? And it tends to start snowballing there after that. But getting that first one done seems to be the biggest wall that folks have to climb.
Yeah, it is, and I'm going to take maybe a different turn in answering this question. But right now it's self-storage is doing very, very well. Many asset classes are doing very well in real estate right now, and self-storage benefits during a recession and benefits during a pandemic. People lose jobs, they have trauma and transition. The storage industry does very well, and so a lot of eyeballs on it. So it's competitive out there. So getting that first deal is beating the brokers to the punch. They're sending out direct mail and talking with the sellers or the owners. We're doing the same thing. And so, there's just a lot of competition in finding that deal. Then I think getting it across the finish line for the first time person, especially if they're transitioning. And I remember back to the first time I was doing this, getting into commercial, into apartments, the banks were saying, well, you've never done this before, so we're going to require you to have a property management company in place, and you can't self-manage. And so adding additional expenses right out of the gate. And the same would go for self-storage. There's many of the lenders out there that would require that, or bringing in somebody that has experience. And so you're giving up some of your equity to do so. So, finding the right deal, the best deal. And I guess on the back end of that, the tough part for folks coming in is that A lot of times they don't know what they don't know. They haven't done their homework enough. They assume this is an easy asset class, and they overpay for something because they didn't know, all of the line items on a P&L that they should be asking questions about of the seller or of the broker. And so some mistakes could be made on that end. So I think that is one of just, I'd say, the pitfalls rather than the challenges of getting into it. That's one of the pitfalls. But one of the simpler ways to directly answer your question, Kevin, is that as you bring in investors into your projects, we have an awful lot of folks that are interested in self-storage. Some of them even that we coach and that we teach, and they come through our academy, and all of a sudden life and business gets in the way and they're too busy to go out and assemble a team and do their own. Well, they come in on the passive side, and so they're a passive investor. They're a limited partner of ours, and they invest $50,000 into one of our funds, or a syndication of one of our projects, and they get to be owners. They get the benefits of that. They get the cash flow, they get the depreciation, they get the profits upon the sale. They own a small percentage of it, and so they get a smaller amount, but they also don't have to take on the credit risk of signing on the loan, guaranteeing the loan. They don't have to staff it. They don't have to, interview management companies and deal with the day-to-day on it. And so that's been what we found. What I never expected that there'd be that many people interested in doing it from that side. But we're finding an awful lot of folks that are looking to do this first, and they gain that experience, they gain the knowledge, they now have this on their resume. So when it comes time for them to do their own deal, they walk into the bank and say, I am an owner, here's my facility or facilities that I'm an investor in. And they can speak the language, they understand it because they're looking at P&Ls, they're looking at our reports, they're on our webinars, and they understand the business a lot more now. So that when it comes time for their own, then it makes it easier to do one that's 100% theirs. So that's one of the easier ways, to be honest with you, to get into the business, to learn about it before you go out and do your own. So just, I guess, a different angle or a different answer to your question.
Love that. No, I love it. And I think you're absolutely right. I think there's a lot of folks that start, looking into real estate. They kind of choose an asset class that they, are drawn to. They research it, and theoretically, it seems like a beautiful thing, right? I get in, I own this property. It's all sunshine and rainbows. And as we know, being operators, being in the trenches, like you said, the property management, or just the overall operation side, it's not sexy. There's nothing sexy about it. And I don't care what kind of, whether it's a mobile home park or a self-storage facility or an apartment complex, there really isn't anything sexy about it.
Nope.
The sexy part is actually being proud of owning it and not actually making money from it, but actually it takes a lot of, blood, sweat, and tears to actually extract the juice from the orange, so in any event, no, I think that's a beautiful way to put it, as far as, getting in on the limited side, getting to get a look underneath the hood of the business, and getting a track record from an ownership perspective, and making it a little easier on the lending side. So let's speak about the lending. What type of debt is out there in the marketplace today for self-storage facilities?
Well, again, storage has really benefited from this pandemic, and it benefits during a recession, which, who knows? I've been predicting, in the next year, but I've been saying that for the next 5 years. we're going to get there eventually. Self-storage does very well during a recession because, when there's trauma and transition, businesses downsize, people move in with their, family and friends, and, then storage goes up. The demand for storage goes up. At the same time, during a recession, the banks shut off the development financing. So you've got a limited supply, that are coming, facilities are coming online, and a huge demand for people that are looking for storage. And so it is an asset class that does very well. So it has a very low loan default rate and a low loan credit loss rate. And so, at that time, and even prior to the recession, then these savings and loans, community banks, credit unions, they're looking to put these self-storage facilities on the balance sheet, on their books, because they know heading into a recession, this will, make them look strong, and the feds will continue to give them money so that they can continue to lend on self-storage facilities and mobile home parks and whatever else that they want to. So long-winded answer to your question, it's very favorable. We have a lot of banks that are very interested in self-storage. The SBA has a program that'll allow you to go up to 90% LTV, because they view this as a small business. It is a small business and has a real estate component to it. So we have some very, very favorable lending on that side as well. Rates are good. We're very attractive to the insurance companies and pension funds right now for those same reasons. It's a very low risk place for them to be able to, put the proceeds and, have it earn some money before they have to pay it out in a pension fund or an insurance company. So we get a lot of looks by a lot of lenders, and again, private equity, same thing. These are just bankers. They're hedge funds that are acting like bankers that are looking for a return on a loan, on an investment. And so we don't have a lot of problem attracting capital right now. It's just making sure that we have a good solid deal and being able to tell that
Yeah.
story. But the money's out there. It's going into self-storage.
Are there non-recourse options? Are the life companies that you've worked with, do they offer non-recourse or, burn offs of the recourse?
Yeah, yeah. That all took a hit, and came to a screeching halt last
Oh
year
yeah,
around March,
right.
April timeframe. But about 3 months after that, and I think in another conversation you and I had, Kevin, that those lenders were coming back to mobile home parks even before they were coming back to our asset class. And so, or else you're looking harder than we were, because we weren't getting that right away. But absolutely, that it's out there, because again, the numbers kind of speak for themselves, and that it's just a very, very low credit risk. And so they're willing to lend on the asset. They know if they take it back and put it in receivership, they'll be able to turn around and sell it again. So we can get that non-recourse debt, and the rates are really coming down now. We were able to get non-recourse, last year, third quarter, fourth quarter. A lot of it was still in that 7 to 8% range, but now we're seeing non-recourse coming down around the 6 and even below 6. But that's with a very strong balance sheet. Regardless, the carve out for the bad boy carve out, and
Yep.
just the assets have to match it in order to get that. But it is still non-recourse on the facility itself.
Now, what are the pros and cons? I mean, what would ultimately make you go with an SBA loan versus one of these other alternatives?
Yeah, the SBA allows you to go with a higher LTV, so
Yeah.
less cash out of pocket, less capital to raise, less cash out of your pocket, high fees, but a lower credit score to get in too. So I think they're at 650. They begin to take a look, whereas some of the other lenders, you may have to buy your rate. If you have a 650 credit score, and so very, very favorable. And also for first time buyers, the SBA, that's what they're designed for, is to grow small businesses and get money out into the marketplace for small businesses. And so you don't have to have a vast amount of experience to qualify for an SBA loan if it's your first self-storage facility. So the flip side of that, going with a lender, if you're seasoned, or these credit unions, savings and loans, community banks, low rates, very low origination fees, or fees across the board. They'll still look at you if you're a first-time buyer, but they'll also look under the hood of your business and see, even though your credit score may be a little bit lower, they'll take the time to say, oh, well, that's because you have a lot of inquiries, because you do a lot of deals, and it's in our backyard, and we know the facility. We can drive by it, see it, touch it, feel it, and we'd like to have this in our portfolio, and we hold this. We're not looking to sell it off and package it. So they're willing to be more flexible in how they put a deal together, because they're going to keep it in-house. They're not going to try to package it up and sell it off to Wall Street.
Yeah, no, all great. Switch over to the economic side of things. What let's speak more so to the length of tenancy. What is the average length across the board as far as how long someone actually rents a specific storage unit?
Yeah, always the answer is it depends, but by
Sure.
industry, about 13 months right now is what we're
Okay.
looking at. Depends upon the class of facility, the market that it's in, demographics, and there's even areas that are more transient than others. If you're in a military town, college towns, obviously the
Right.
move-ins, move-outs, and average tenancy is going to be a little bit longer than others. But by and large, 13 is the average. But the interesting thing is that we've got some folks that will literally, everybody says, well, I'm going to be here for 3 months. I'm just putting this stuff here while I clean out the garage or figure out what to do with it, and or sell it off. And those are the folks that either they just realize, okay, I really did need that extra space, and they love it, and they stay, and they continue to put stuff in it, or they just forget about it and they just continue to pay for 7, 8, 9 years, because it's easier to just pay the $50, $100 than it is to go figure out what to do with it. So for all those folks that truly do use it, for 3 months, hey, the basement flooded, we got to get it remodeled. We're moving, so we're going to put stuff here while we stage our house, get all the kids' stuff out, and make it look good. And then once we finish our move, we move it back out. But for all of those, then we do have the folks that stay long periods of time, and so it kind of averages out. So we've got a small amount of folks that that turn a lot, and then we've got a long-term tenants that the lock's rusted, and I don't know how they'd ever get it off because they've been there so long.
That's it. I mean, no one likes moving, and sometimes it's just easier to pay the $130 a month
It
and
is,
not have to go rent a truck and take up your entire salary to go move that stuff again somewhere
Yep,
else.
you got it. Yep.
How about sensitivity to rent increases? One of the value add components I'm guessing is finding a facility that has under market rates. And what is the sensitivity of existing tenants? When they see a $10 or $15
Yeah.
a month rent bump.
Well, Kevin, music to your ears and mine is when we're walking shoulder to shoulder with an owner through the mobile home park or through their self-storage facility, and they turn and they say, we haven't raised rates in 10 years. That's why we're 100% full. And they're proud of that. And, to me, that's just, they couldn't have said anything better. Because we know that we can come in and we can move rates. And so we are intentionally looking for the mom and pop owners of facilities that, are just bad managers, bad owners and operators because of that. And so we can go in and, we can raise rates. And the beauty of this is that we're low rates to begin with. So if we're in that, as you mentioned, $100, $50, $130, if you raise rates by 5% or 10% or so, people aren't going to move. They're not going to rent the truck and borrow their, get their brother-in-law and borrow a truck or rent a truck on a Saturday and move their stuff down the road to save $5 or $10. It's just not worth, and pay another $20 administration fee. They're not going to do that. But you got a 400 unit facility, and you multiply that by $10. Okay. So now you got another $400 a month times 12 is, $4,800 a year, at a 5 cap. Well, you just gave yourself a $100,000 raise, a $250,000 raise, depending on the size of your facility, just by raising rates. And our leases are month to month. So technically we could raise rates every month. You're not going to have anybody, move, or you're going to have everybody move if you do that. But every 7-8 months or so, if you have a nuisance increase that's $2 or $3, the value continues to go up. Nobody's going to move, and we're bringing it back in line with the market. If it's a facility we bought that they haven't raised rates, and we're always going to stay a couple $3 below the REITs, the real estate investment trusts. And we follow them. When they raise rates, we're always monitoring, and we're always going to be $2 to $3 below them. And those guys are always pushing rates, period. And so we're just following them. And when everybody's looking online or calling, we're still beneath them, but raising rates on a regular basis. And so that, along with dynamic pricing, is a model that's come into play in the past few years. It's been very popular in self-storage. It's no different than what the airlines do. The closer you get to being full, the time to take off, the price of the ticket goes up. Well, as our occupancy rises, literally in our software, a 10 by 10 goes for $100 and somebody rents it, the next person in line, it's going to be $103 or $104. And it continues to go up as occupancy rises as well. So it's kind of built in.
Yeah, no, that's great. I appreciate you sharing that. And to switch gears real quick here before we wrap things up, Scott, I want to ask you one last question. Most folks only ever talk about the best deal, the deal that made the most money, the highest return for their investors, what have you. We see the posts all over social media about all the positives, but very few times does anyone ever, get vulnerable and actually speak to the worst deal. And doesn't mean you necessarily lost money, but it's the deal that you lost sleep over, gave you additional gray hairs, or, just it was a challenge, to say the least. When I say all those words, what ultimately comes to mind? Do you have that one deal that just was the biggest challenge of a lifetime? If so, what was it? What was the challenge? How'd you overcome it? And then, looking back, what would you have done differently the next time around?
Yeah. So the worst is really on the apartment side. And this was completely my fault. I had a goal that I was going to buy X number of apartment units within a year. And by God, it's September, and I needed to reach that goal. And so there was one project that just kept trying to die, and I wouldn't allow it. So I just kept pushing and pushing and pushing to try to get this thing across the finish line, when everything and everyone was telling me no. And so finally, I kicked down that door and kicked down that wall, and I realized, years later now, that what, if something that is that difficult, it probably God or somebody or something on the other side pushing back. And then finally, when it was let go, I fell in on my face. And so I forced this deal to happen, had the seller carry some money back. I brought in some money from another partner, and then I sold the thing on a seller carryback, and all the way I didn't make money. I thought that I could raise the value of this facility, and it was a neighborhood that it didn't matter. I was going to put all these improvements into the apartment complex and make it look better, attract a better tenant. And at the end of the day, you still get renters that can only afford so much, and they still trash the apartment. And now I just spent all this money, and I had the same as before. I was unsuccessful, and changing the demographic and regentrifying, if you will, even though that's not the best word these days, that market or that area. And so that one, then when I sold it, I had to sell it on with the seller carryback, and that guy defaulted, and so even more money out. So that was the one that is I realized that completely my pride, my ego got in the way. This was very early on. This is 25 years ago, that I shouldn't have done. So since this is about storage, on the storage side, there's one that I bought in a market that all things looked as if this market was turning around. And as many of our projects, no matter what the asset class is, we're building and banking on the fact that either we're buying it undervalued or the market's going to turn. There's something that's happening. in the path of progress. And this facility was in that path of progress, but then all of a sudden, none of it happened. There was a change in local government, and everything that was planned right down the road from this facility on a very busy road all happened in the county next door because they elected the wrong guy who put a nix to everything. And the market just spiraled out of control. We had we had a break-in. We don't have a lot of break-ins in storage, but we had multiple break-ins at this facility. It was located next to a very seedy neighborhood next door, if you will, and behind it was kind of hidden. And just one after another, the gate broke, I don't know, 3 times. So we had $5,000, $5,000, $5,000. It just did not perform well. And we were buying it based on projections on pro forma, which we still do with the information at hand. But none of those things happened, and we're going to sell it. We're getting ready to sell it right now. It's been under contract once, fell out. It's getting ready to go under contract again, and it'll be about a break even. We're selling it at a profit, but not for the money that we had to put into it, unfortunately. So,
gotcha. No, and backing up to the apartment deal. So that was a neighborhood issue, right? Is that what I get?
It was. Okay. It was. Yeah, and my over exuberance as well of thinking that I could change the neighborhood.
That's it. I mean, you can fix the property, but you can't fix the market. That's why the market is by far the most important thing, or the immediate neighborhood surrounding it. Mm-hmm. So no, I appreciate you sharing that and being vulnerable. I mean, again, it's tough to talk about some of those because again, we've already thought about them probably for hundreds of hours as we're living the experiences, and the last thing we want to do is talk about it again, but I appreciate you sharing that. And
well, that's why we do this. We're here to teach people, and nobody wants to hear about all the money everybody makes. You learn from your mistakes personally, and other people can learn so that they don't have to spend the dollars with the market teaching them the lesson. So heed what Kevin and I tell you.
Scott, where's the best place that folks can learn more about you and what you got going on?
Yeah, all things self-storage over at selfstorageinvesting.com. We've got lots of free white papers and things, resources to pull down. So head on over there, and we'll begin to teach you about the business and show you what it's like to get in.
Are you back to doing live events again?
We are, as a matter of fact. We've had a few early this year and getting ready to go do another one out in Arizona. And so we're back off to the races again. Mm-hmm.
Very good. Well, guys, if you want to learn about self-storage, please go check out the website. I'll put it in the show notes as well. And Scott, as always a pleasure catching up with you, my friend. Appreciate you coming back and joining us.
Anytime, Kevin. Good to see you again.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You guys take care.